Warning lights are flashing red across Wall Street, and if you've been watching your portfolio bleed this week, you might be blaming the Middle East. Oil has completely skyrocketed past $100 a barrel. Global tensions are at a boiling point after the recent strikes in Iran, and panic is setting in. But what if I told you the crash was already baked in? What if the geopolitical chaos was just the pin that popped a massive hidden stock market bubble? Today we are looking at an uncanny S&P 500 chart that looks absolutely terrifying and exactly like the year 2000 dot-com crash. Strap in, because the market might be about to take the elevator straight down. Before we dive into the data, a quick reminder, I am not a financial advisor and everything in this video is for entertainment and educational purposes only. Always do your own research before making any investment decisions. Welcome back to the Daily Stock Drop. Hit that subscribe button and let's get into the news. Let's look at a brand new eye-opening report from MarketWatch that is making the rounds among institutional traders. The headline says it all. This uncanny S&P 500 chart suggests a bubble is bursting, and not just because of Iran. Right now, everyone is pointing fingers at the late February strikes in Iran and the massive disruption in the Strait of Hormuz, sending crude oil prices to the moon. And yes, those events rattled the markets, but according to top market analysts, the S&P 500 was already standing on a trap door. Experts are pointing to a terrifying chart parallel between the S&P 500 today and how it behaved in early 2000, right before the dot-com bubble completely wiped out trillions of dollars in wealth. The argument here is simple. A bubble's burst isn't just about the specific straw that breaks the camel's back. It's about the fact that the camel was already carrying way too much weight. So what are the red flags we missed? The topping pattern has been forming right in front of us. Analysts note 3 massive warning signs over the past 5 months. Number 1, a massive slowdown in the S&P 500's upward momentum. Number 2, a slow, steady creep upward in market volatility. Number 3, a quiet, underlying rotation of money out of big tech and into small cap and value stocks. The smart money was already rotating to safety. There's an old saying on Wall Street, markets take the stairs up, but they take the elevator down. While bear market bottoms usually snap back quickly in a V shape, bull market tops slowly erode before the floor finally gives out. And right now, higher volatility is forcing huge institutional funds to shrink their books and cut leverage, which naturally brings prices down even further. So how does this relate to you, the everyday investor? First, it means you can't just blame the news cycle. Geopolitical events like the Iran conflict or spiking oil prices are catalysts, but the underlying structure of the market dictates the severity of the drop. If this 2000-era chart pattern plays out, we could be looking at a prolonged period of downward pressure, not just a one-week dip. Second, pay attention to where the money is going. If institutional money is rotating into small cap and value stocks, it might be time to look at your own portfolio. Are you over-leveraged in mega-cap growth stocks that are sitting at stretched valuations? Now is the time to check your risk management, keep an eye on the VIX, and maybe look into defensive sectors that can survive a high oil price, high volatility environment. The market is shifting fast, and we are going to be tracking every single drop right here. What do you guys think? Are we heading for a dot-com style crash, or is this just a temporary geopolitical shakeout? Let me know in the comments below. Drop a like if you found this breakdown helpful, subscribe for your daily market updates, and I'll see you in the next one.